Hello, everybody. This is Noah and John, and we are from UrbanDigs, and it is Friday. So you're going to get your weekly Manhattan market update. John, let's get right to it. I'm looking at supply. We're finally ticking up 52.34. Show me that chart.
Yeah, finally a tick up there. We had a tick down the week before. There were some upticks previously, but it looks like, we talked about supply kind of hitting its bottom and ticking up, and it really seems like that trend is in place now. Noah, supply up 3% on the week.
That's right. That is a welcome sign. We want to see more listings hitting the market. We're going to take a look at the weeklies. Maybe there's some clues there as to why supply is ticking up. But until then, Johnny, let's shift to pending sales. 4171. That looks like a tick lower. Show me that chart.
It is a tick lower, a tiny tick lower by 0.2% down. So it's really a sideways move essentially for pending sales, and I think that's what we're going to see. But if you start thinking about the weeklies in the months ahead, I think we're going to start seeing a lot more contract signs hitting the market, and I do expect pending sales to start climbing from here. So today sideways, tomorrow up most likely.
Yeah, I hear what you're saying. And we did actually turn around with pending sales, and we did tick up for the last few weeks, which was strange. We said that this is a little early for this to happen. So it looks like maybe normalizing right now. And that is why the market pulse ticked down. If you're asking, we got supply ticking up, we got pending sales ticking down. You put those two together, the market pulse is ticking a little lower. It was ticking higher, and we're asking what's going on here. Now it's starting to normalize a little bit. So we'll keep an eye about that. Buyers probably do not feel like they're getting much options out there, but it's slowly ticking that way. We'll see where it goes. John, let's go to the weeklies. I'm looking at supply 488. That's a nice pop. Show me the chart.
It is a nice pop. We're not 9% or so on the week. Back close to 500 here, not over that mark just yet, but Noah, it's nice to see, getting up there.
Yeah, and that's what we're targeting, right? We're looking for 550 or something. That's what we need. We need consistent 500, 550. Man, maybe even 600 listings. I don't know. We never really hit that level, but we'll see if we hit it this year. We'll keep an eye on it, Johnny. Let's look at contract signed. We're over the 300 level, 309, up 8%. Show me that chart.
Yeah, 309 is the most we've seen this year. It's actually the most we've seen really until you go back to October or so. And that's up 8% on the week, Noah. So if you look at what weekly new listings are, 9%, and you look at contract signed, 8%, you really want to start seeing more supply coming onto the market, especially if we're looking at 8% gains for contract signs.
Yeah, it's just getting absorbed, and you add an off market, you got 309 contracts signed, you got 135 off markets, you add those together. We finally have some net positives for inventory. So that's going to help supply a little bit. We'll see how long that goes for it. If I go to my 1 month, you can see what's going on here. We're up to 1,711 on supply. I believe we reached 2,500 at our peaks listing season, fall and spring last year. So that's the kind of high watermark that I'm keeping an eye on. 1,175 in contract signed on the 30-day. We reached 1,800 at our peak last April, May. So just to give you an idea of what it was like last year and what it's like right now as we head into April and May, we need to get that up a lot higher. Otherwise, it'll be just a different market. The only thing that's different, a lot less inventory today than a year ago. So it probably it feels like the urgency is the same, Johnny. Okay, Johnny, let's go move on to the chart du jour. And we got here the market pulse by price range, Johnny. And why don't you go kick us off? What are you seeing here?
Well, let's not forget what the market pulse is. It's basically a ratio of what's in contract to what's in supply, and it's really a barometer of market leverage. And so what I like to point your attention to is, if you could start highlighting the first quarter really of each year and just kind of get a sense of what that market pulse does each year. Look at January 19, comes down, goes sideways. 2020 comes down a little bit, goes sideways. 2021, it just goes straight up. Here we are, 2022, we've come down. Well, if history is any guide, Noah, we're going to be going sideways here. So yes, there's going to be supply coming on, but most likely market pulse is going to go sideways. Yes, and it's higher than it's been.
Right. And I think that's the key point I want to point out here. If you take a look at all of these points right here, they are higher than they are over here, and over here. So that is the overriding point. I understand that they're all down from their higher levels earlier, about a few months ago. But if you take a look at what's going on, this is indicative of a very tight market. This is indicative of an inventory constrained market. Buyers, you do not have much leverage. Sellers, if you're not selling, your price is wrong. And I just wanted to show you, if we change this chart and we show you the percentage change in this pulse, take a look at what the higher end, take a look at what the higher end, 10 million, 5 to 10 million, 2 to 5 million, 10 million plus right here, all right, 5 to 10 right over here, and then the 2 to 5 million in green right here. the percentage change of those sectors in relation to the lower end, which is underperforming, it's quite amazing to see. And this is what we've been saying, guys, is that the luxury sector, or at least the 2 million and above sector, has been outperforming the other sectors. And this is a nice visual. And this is also a nice visual to explain why you're seeing a pop in price action as well, Johnny.
Yeah, you're exactly right, Noah. And that's one of the things that, luxury has been doing its own thing. And, within real estate, it's always you have to add the disclaimer that your mileage may vary here. So if you're looking at that 600 to a million, 1 to 2 million, you can see that your market's a little bit more negotiable, not a lot, but it's a bit more negotiable than it was last fall. So even though everything has kind of shifted up in the market, and we've talked about no supply, and we've talked about how prices are ticking up, in these sectors, they are a bit more negotiable. So you kind of have to watch out for that. And this is a great sort of visual, as you said, to explain that.
Yeah, thank you, Johnny. This is great stuff. Thank you for whipping up all that data. That is John Walkup. I am Noah Rosenblatt. We are both from UrbanDigs. Don't forget, you got questions, we got answers. We got our forum right down here. If you want any of the reports we talked about today, they'll be right over here. Other than that, this has been your weekly Manhattan market update. We'll catch you next time.